This is the second in a series of videos that are showing you some the instructions on how to set up the net farm income before you can actually begin to calculate rate of return on investment or the rate of return on equity. I'm starting this one where the last one left off. I've shown you the net farm income from operations and then the subtraction of the allocation for unpaid family labor. So now we get this net farm income from operations after we charge for some unpaid labor of $152,037. Now, the next concept is to add the total interest back. So you come in here and add interest. Okay. So the interest is $78,794. And that number comes from right there, total interest. Okay. So that will give us a total of $230,831. Now, use your common sense. When you add the interest back, it basically would assume that this interest payment right here was zero. So if that interest is zero, that simply means there's no liabilities. So what happens is that leads you to the fact that we're dealing with a farm that has no debt. So if this farm that we've got, if J&J Farms had no debt whatsoever, their net farm income from operations would be $230,831 after you made an allocation for unpaid family labor. Okay, now this is a very important number, this 230,000, but it treats the farm as of no debt. So don't forget that. This would be if there was no debt. Now we know the farm has debt, but we're arriving at a value of what the net farm income would be if there was no debt. Now this is a very common calculation in the estimation of profitability ratios. It's so common that farm management and ag accounting courses nationwide have adopted a term. They refer to this as adjusted net farm income. That's a very specific term, adjusted net farm income. So if you come down here and say adjusted net farm income, what it is, it's net farm income from operations plus interest minus the opportunity cost of unpaid labor and management. Unpaid labor and management. Okay? The very, very, very important concept, adjusted net farm income. It treats the farm as it has zero debt, and it incorporates a payment, even though it's not a cash payment. It incorporates an allocation for unpaid family labor. So if you really get down to the nuts and bolts of this number is a return to the investment by the business manager. Because since you've paid all the contribution of all the operating inputs, you've paid for the contribution of all the machinery through depreciation, and now the things that you haven't paid when you get that 202,000 net farm income from operations is simply family labor and a rate of return on the assets. So when you allocate that 50,000 for unpaid labor, essentially when you get adjusted net farm income, you've got a rate of return to total assets. Okay, now this is important. If this didn't make sense, please listen to it again, because this adjusted net farm income now, it treats the farm as if there's no debt, and it makes an allocation for the unpaid family labor and management. Now we're going to pick up right here in the next video and begin to show you how to calculate rates of return.